After a delay, we finally have those latest U.S. inflation numbers in hand. Do they open the door for a Fed rate cut next week? Joining us now to discuss is Gennadiy Goldberg, Managing Director and Head of U.S. Rate Strategy with TD Securities. Gennadiy, great to have you on the program again.
Thanks for having me.
Let's dig into that report. We waited long enough. We got it. What did it tell you? What did it look like?
Well, it was a little bit softer than expected. I think that's the important thing. Specifically, it was softer in things like housing, and that's a really good forward-looking indicator. We do expect housing to continue to weigh on inflation. The pass-through from goods was not as visible as I think many have expected. It just suggests that goods pass-through, because of trade uncertainty, is going to be continuing to act for a little bit longer. And then if you look at core services, they were a little bit firmer, but not too firm. And at the end of the day, this really just kind of suggests that inflation is still very much under control, even as this kind of tariff pass-through is continuing to happen.
Now, when we think of the fact that it did come in a tick lighter, the markets clearly like it because it's always about expectations for the markets. We're still talking about, I think, a core at 3, a headline at 3. What does the Fed do with that number next week?
Just kind of continuing on their path, unfortunately. We as you mentioned, data light. I know this is the first official government data release in just almost a month, effectively, and we really don't know when we get the next one. This really just reinforces the ongoing view. I mean, the market was basically fully priced for a 25 basis point rate cut in October. They were a little bit less than 25 priced for December. So after this print, you saw quite a bit of market chop. But at the end of the day, the pricing for October basically remained unchanged. December went up by a couple of basis points. So now we're fully priced for October and December. I think the Fed's going to move very cautiously. They're not going to change their tack. I think they're going to be one meeting at a time, one data point at a time. The problem with data dependency is in the absence of data, what do you look at? And this is really no longer a data-dependent Fed, because there's not really a whole heck of a lot of data to have.
When I think of their dual mandate, right, people can say, well, it doesn't matter that, inflation's at 3, it's above target, because we're more concerned about the labor market, also numbers that we are not getting. So what does the Fed have to hang its hat on here?
Well, we are getting some private sector data on the labor market, and it's showing us that the labor market remains generally softer. So what we are seeing is, very low hire, low fire type of environment, but also just kind of a gradual moderation in labor markets. And this particular cut is not exactly controversial. We're at 4.25%. Most of the FOMC sees neutral somewhere in the range of 275 to 350. The median's at 3%. We're way off neutral. So for the most part, most of the FOMC is going to agree for rate cuts to rate cuts this time around. You may have a dissent from Stephen Myron arguing for a 50 basis point rate cut. You may see a hawk dissent as well, just given that inflation's a little bit firmer. But at the end of the day, the Fed is continuing to gradually take rates lower and trying to look at data along the way. The problem is, there's not as much data to look at, and what they are seeing is just reinforcing the trends from before.
Of course, that is because of the U.S. government shutdown. I think I saw a headline the other day that we're now in the second longest shutdown in U.S. history. We don't have an end in sight. Is the economy starting to feel this yet? And how would the Fed have to put that into its calculus going forward?
It's tough to say. I mean, part of the issue is we don't know if the economy is starting to feel it because we don't have data. The longer this drags on, the more kind of furloughed workers you have who are not spending money, who are not being paid. It will become damaging. I think the biggest pressure point for typical U.S. consumers is going to be travel specifically. So the fact that TSA workers and air traffic controllers are not being paid will eventually start to weigh, and because it'll create airport delays and things of that nature, and that will be lost business opportunity effectively. The issue is, we're talking about this being bound by potentially the U.S. Thanksgiving travel season, which is late November. So this could be, if this is the longest shutdown of all time, which is going to be in early November, this could last for an even longer period of time than anybody expects. So the pressure points aren't really being felt at the moment. You see, equities in the U.S. at record highs. It's not really being felt, and I think that's taking a little bit of pressure off of Congress to get something done very, very quickly.
Now, apart from those concerns, obviously, last week, and I feel like the market sort of brushed this one aside, they were starting to get concerns about credit quality. They were cropping up, and the market seems to have sort of forgotten about it for now. Thoughts on that, and if the Fed has to think about that as well?
I think that's always a consideration for the Fed. They're always on the lookout for some sort of, as Jamie Dimon called it, cockroaches in the credit markets. We are always on the lookout for that. I think the losses just triggered a little bit of kind of post-traumatic stress in the wake of SVB. I don't think they're particularly notable at the moment. The losses in the banking system seem to be relatively modest. But over time, we're watchful to see if any of the credit quality deteriorates. If you look at corporate markets, spreads are still right near record heights. Even the high yield markets haven't really adjusted all that dramatically. I don't think the market views this as a huge problem, but this is something the Fed's certainly going to have to keep an eye on. And if anything, this kind of reinforces the idea that they should be gradually easing policy to help put a little bit of easing into the system just in case one of these shocks comes out of left field.
All right, let's murky the waters even more and talk about the trade front. Obviously, headlines this morning, Washington ending negotiations with us here in Canada. They don't like that Reagan ad about tariffs and the economy. Of course, Presidents Trump and Xi supposed to meet next week. There's always tensions around there. What are the economic implications around all this?
The market didn't really make too much of it, which I find quite interesting. I do think the market's starting to understand that there's a lot of noise around these negotiations. If anything, this just injects more volatility into an already uncertain topic. Just last week, the negotiations with Trump and Xi were effectively broken off. It didn't look like they were going to meet. Now they're going to meet. So I think the market realizes that this changes really on a day-by-day basis. Our understanding is there have been negotiations and they have been making progress. So perhaps this is for some of the high-level leaders to smooth over, to do a little bit of a mea culpa and get things back on track. It doesn't seem like markets are too concerned about this. Obviously, if this continues, that's going to be a source of uncertainty. But at the moment, it seems like markets are just kind of letting this one ride until they get a little bit more clarity.
Now, Gennadiy, we have a lot to deal with in the here and now, and you've broken it down nicely. Going forward in these final couple of months, what we got? 3 months left, 2.5 months left in the year. I get it on my calendar. You know what I'm trying to get at. What do you got your eyes on?
We're still trying to figure out how the U.S. economy is doing. Everything we have at the moment, obviously we're flying, call it 75% blind, does point to the U.S. economy doing okay. It's still very much a two-speed economy, the kind of the haves and the have-nots. The unemployment rate, again, the last data we have is still relatively low. The high-frequency data we are getting in the shutdown doesn't suggest that firing is picking up. So we're trying to figure out really where the next pressure point is going to be. That means, in our minds, kind of consistent, gradual Fed rate cuts. We're looking for the 10-year to finish the year at 3.9%. In the U.S., 3.5% by the end of next year. So this gradual drift lower in rates, that's really what we're looking at. And we're looking at anything that could be a pressure point, both to the upside and the downside. I think the tail risks have become elevated almost in both directions. So we're much more focused on tail risks as we head into 2026 than we were before.